I could go back to the beginning of my investment journey, I'd do a lot of things differently. I chased hype stocks, I panicked during corrections, and worst of all, I wasted time trying to be smart instead of consistent. In this video, I'm sharing the 6 biggest lessons I've learned the hard way. These are the things I would do completely differently if I had to start from scratch, and they might just save you years of mistakes. So let's dive in. Lesson number 1, I'd focus on fewer, better businesses. Early on, I thought diversification meant buying every stock I heard about. I ended up with a portfolio of 20 companies I didn't really understand. If I could start over, I'd focus on 5 to 10 great businesses I knew inside and out. Companies like Apple, Visa, or Costco, with strong cash flow, pricing power, and durable competitive edge. These companies aren't just household names, they're predictable, they reinvest profits effectively, and they've proven they can perform across different economic cycles. What I missed early on was depth over breadth. Knowing one company inside and out beats holding 10 you barely understand. I'd spend more time reading annual reports, listening to earnings calls, and following the story of each business like I was a part owner. Because I would be. Instead of collecting tickers, I'd build conviction. Remember, when you buy a share, you're becoming a part owner of a real business. If you wouldn't want to own the whole company, why own even a single share? Lesson number 2, I'd avoid the noise. Back then, I checked stock prices consistently. Every market headline felt urgent. Every dip felt like a disaster, but here's the truth. Most of the noise doesn't matter. Markets rise and fall every day, but great businesses keep delivering results quarter after quarter. The financial media makes money from attention, not accuracy. Every day, there's a new crisis, a new bubble, a new must-buy or must-sell alert. And if you let it, the noise can hijack your emotions and lead to terrible decisions. I used to react to headlines, refresh my portfolio like it was social media, and make impulsive trades based on someone's hot take. It was mentally exhausting and financially draining. Today, I've learned to zoom out. I follow long-term trends, not day-to-day swings. I listen to companies, not commentators. I focus on long-term results, annual reports, and the actual business behind the share price, not what a pundit thinks might happen this week. One of the best habits I've built, checking updates once a quarter, not every morning. Here's the kicker. Overtrading has been proven to hurt returns. A landmark study titled "Trading is Hazardous to Your Wealth" showed that investors who traded the most actually underperformed the market by more than 6% per year. Why? Because they reacted emotionally to short-term noise, trying to time every move. And the more you trade, the more you get in your own way. It frees your mind, protects your portfolio, and puts you in control. In the end, avoiding the noise isn't just about peace of mind. It's a strategy that strengthens your long-term investing game. Less reacting, more compounding. Lesson number 3, I'd learn the business before buying. In the early days, I bought companies based on tips, trends, and gut feel, not research. And I paid for it. If I didn't understand how a company made money, who its competitors were, or what its risks were, I had no business owning it. What I do differently today is simple. Only invest in companies I can explain in 60 seconds or less, clearly and confidently. Do they generate consistent revenue? Are they growing profits? Do I believe they'll be stronger in 5 or 10 years? This is how Warren Buffett invests. He calls it staying within your circle of competence. Buffett has famously avoided tech for decades, not because it wasn't profitable, but because it was outside his core understanding. When he did buy Apple, it was because he saw it as a consumer business with predictable cash flows, not a speculative tech play. But Buffett doesn't chase complexity, he seeks clarity. And that clarity compounds. So if you can't explain what a business does, how it makes money, and why it has an edge, I won't invest in it. I'd rather wait for the pitch I fully understand than swing at every shiny new idea. It's not about guessing the next big thing, it's about buying great businesses and giving them time to grow. Lesson number 4, I'd stop trying to time the market. I used to obsess over finding the perfect entry point. I'd wait for dips, I'd hold off until things looked safer, and I missed some incredible opportunities because of it. One of the best lessons I've learned is this: you don't need perfect timing. You just need time in the market. Let me give you an example. Say you bought Apple at 150 or at 135. Does it really matter if it's worth 400 a decade later? Now here's where it gets real. A JP Morgan study found that if you missed just the 10 best days in the market over a 20-year period, your overall returns were cut in half. And most of these best days, they come right after the worst ones. That means if you bailed out during a correction, you likely missed the rebound. And that's where the huge chunk of gains come from. The market doesn't send invitations, You have to be in the seat when the opportunity shows up. The smartest investors don't try to be clever. They buy great businesses and let time do the heavy lifting. So instead of trying to buy the dip or sell the top, I'd focus on consistency and conviction, because time in the market always beats timing the market. Lesson number 5. I'd reinvest dividends and let compounding do the work. When I first started investing, I saw dividends as a bonus, a little extra cash I could spend or let sit. But what I didn't realize was that those small payments were the key to one of the most powerful forces in investing: compounding. Reinvesting dividends doesn't feel exciting at first. It's slow, it's quiet, but over time, it adds up in a big way. Here's the hard truth. Over 70% of the S&P 500's total return over the last 50 years has come from reinvested dividends. Not stock picking, not timing, just reinvesting what you already earned. Let's take Coca-Cola, one of Warren Buffett's most famous long-term holdings. Buffett started buying in 1988. Today, Berkshire Hathaway earns over $700 million per year in dividends from Coke alone. And it didn't get there by taking those payments out. The dividends were reinvested, snowballing his ownership and boosting future payouts. Or consider Procter & Gamble or Johnson & Johnson, dividend aristocrats that have raised payouts every year for decades. A $10,000 investment in either of them 30 years ago, with dividends reinvested, would be worth more than double what it would be if you had simply taken the cash. Even growth-focused companies like Apple have quietly turned into dividend machines. Since initiating a dividend in 2012, Apple has paid out over $150 billion. A long-term investor who reinvested have seen their positions multiply. Reinvestment isn't just a tactic, it's a mindset. It's the belief that every dollar earned should keep working. So if I could go back, I'd set every dividend to reinvest automatically. No second guessing, no withdrawals. I'd treat each payment like a building block, stacking on top of the last, because with enough time, those small reinvestments don't just grow, they multiply. Lesson number 6, I'd keep adding to my portfolio no matter what the market's doing. One of my biggest mistakes, I'd buy once, then hesitate, I'd wait for a dip, I'd second guess myself. Now I know, consistently adding to your holdings, especially during uncertain times, is where the magic happens. Let's go back to Apple in 2013. It dropped over 35% from its highs. People panicked, but the fundamentals were still strong. If you had added to your position in that dip, you'd be sitting on a 10x return today. And it's not just Apple. Historically, the best long-term returns have often come from money invested during downturns. A study by Fidelity found that the best performing accounts weren't owned by professional traders. They were owned by people who either forgot they had an account or had passed away. Why? Because they never stopped investing and never tried to time the market. There's also the concept of dollar cost averaging, investing the same amount regularly regardless of market conditions. It smooths out volatility, reduces emotional decision making, and ensures you're buying more when prices are lower. Whether it's a booming bull market or a scary correction, the discipline of continuing to invest week after week, month after month builds real wealth. Buying more of a great company when it's temporarily out of favor isn't risky, it's smart. So instead of overthinking every move, I'd set up a schedule, automate it, and just keep going. Because in the long run, consistently beats brilliance. So let's recap. 1. Focus on fewer, better businesses. Avoid the noise. Understand the business before you buy. Stop trying to time the market. Reinvest your dividends. Keep adding, no matter what the market's doing. If I could start over, that's the blueprint I'd follow. And if you're early in your journey, you've got the gift of time. Don't waste it. Now, I'd love to hear from you. What's one mistake you wish you could undo, or one lesson you'd give your younger self? Drop it in the comments. And if you found this helpful, make sure to hit the subscribe button, and we'll see you in the next video.